Hey, what's up, guys? This is Sparrow 3.88. Today is Monday, March 29th, 2021. And we're going to have a quick look to see what the market has been going on through the weekend. And I think there was a news just happening last Friday about it's a bad news, and it's also I think it's gonna be a bad news with a lot of complicated stories or manipulation or conspiracy behind. And and today's broadcasting, we just want to have a um easy understanding to see how the story just happened last Friday. Let's check out from some web article. Okay, so according to Financial Times, Credit Suisse and Nomura warn of losses after Archego's linked sell-off. Archego is a US-based hedge fund, um, and the hedge fund's origin is from a Korean family office owner. But anyway, in this article, it says banks faces earnings hit following 20 billion stock fire sale by prime brokerage clients. Okay, so I mean, this just happened last Friday. So the market has been reporting and expecting it will it will make a big hit and big fluctuation for today's market open. But uh, by the look right now, the U.S. market seems to be okay so far. S&P 500 has been down for 0.60%, and Dow down for 0.38%, and Nasdaq down for 0.7%, and crude oil price down for about 0.87%. So it's not it's not too bad so far. But this story and this news, this event will probably have some more ripple effect, ongoing ripple effect, and we'll need to keep a close eye on that. So here as you can see, this is a very updated news saying a hedge fund liquidation has wiped billions from Chinese and US stocks, and no one knows what's going to happen next. This is the big news we have to keep an eye on today, and probably for the whole week this week, to see if it's gonna affect the market badly. And according to Reuters, it also says Nomura, Credit Suisse warn on losses after Archego's share dump. So let's have a quick look to see the Bloomberg briefing report just posted earlier. It says the forced liquidation of more than 20 billion of positions linked to Archego's capital management may worsen as some of the world's biggest banks tally their exposure to the wrong way bets by the firm. And Bloomberg opinion has some detail for this. Let's have a check to see how they report this.
This is just the beginning of something that could turn uglier. Well, thanks so much for having me on the show. I think that the problem is just like Morgan Stanley and Goldman Sachs, they were the American banks that, in a way, firm ran the European and the Japanese banks. They sold first, right? And then we know Nomura and the Credit Suisse, they're still in the process of selling. And unfortunately, Bill won some of his stock positions, especially in the Chinese internet companies. They are kind of tricky to sell because they're not like your Tencent or Alibaba. These stocks are more niche and they're not cheap. They never have quite a bit of a long only institutional investor backing. So I see that these banks will have a tougher time selling those trades.
Surely will actually change. I mean, it's really quite amazing how, everything is interconnected, and just kind of also reminds us on, some of these big clients, how important they are. Will it change the way some of the banks or some of the margin calls will operate? Or is this very idiosyncratic just because of Bill Huang's family office?
Well, Bill Wen, this is not the first time he got margin called. After the Lehman Brothers bankruptcy, he got short squeezed on the Volkswagen trade in October 2008. And back then, the big banks were giving the basically big hedge funds too much leverage. So that was basically 12, 13 years ago, and we are here again. So I don't know. I hope the banks get to improve their compliances. Like right now, it seems to me a mismanagement problem. The prime brokerages, the front office is basically overran the compliance and the risk department's decisions. And they gave Bill Wen so much leverage, and now they're basically having to soak up the losses.
How much more pain surely could we see? And this is the premise of all of your opinion piece, and you were just talking about it when we started this interview. How much more pain could there be ahead, and would it be done by the end of today, or could it continue for a couple of days?
I feel like it could continue for a couple of days. Going back to the column, basically in March, the U.S. long-short equity hedge funds, they haven't been doing very well. All the crowded trades that they piled into, these stocks got sold off the most. As we know, the stock market is doing a reflation trade and the value rotation, so on and so forth. So I think, some of his media picks, Biocom, yes, and the Discovery, it's not just his picks. Other hedge funds were in there too, right? They might also get margin calls. So I think it would be interesting to see how it plays out.
Sure. Skip this ad. Just like you skipped out on buying Amazon stock and Google and Apple. I'm sure you think you're too busy to invest online.
Sorry about my microphone. So I was just saying, sorry about for my clumsy screening transition. Okay, so after the Bloomberg briefing video, we're just gonna take a look at the Bloomberg news report to see how this crazy event just happened last Friday, and what's going on for the whole story. But before that, I want to say, like, started from last year 2020 until this year. Obviously there are just I mean, just I mean, crazy events like one after another popping out, and the market seems to be really crazy. And um, I think I mean, I think the capital market a lot of time it's good. It's good for people to make money. It's good for business, and for it's good for the economy to grow. But when I mean anything, when it goes out of control, the result could be really terrible, especially when human beings are uh, addicted to or become like really greedy for a certain kind of desire, like money, like sex, like drug. Things could be really terrible. So I think that's just what has been going on in I mean since last year. So hopefully uh, to all the audience, uh, I hope, like, besides making money, besides like getting addicted to all those desire, uh, I mean, in these like disaster times, I mean, we can spend some time to actually cool down, to calm down, and introspect, to inspect ourselves, to see what's the true value, what's the true happiness of our life, instead of keep chasing for money, profit, or all those kind of uh, um, desire or bad things. So yeah, back to the topic, back to the news. Billions in secret derivatives at center of Archego's blow up. So Archego is the hedge fund, and this guy is the manager, is the CEO for this hedge fund. He's a Korean American, probably. So we're going to go through the Bloomberg article and to see what's going on. So so Bloomberg says the forced liquidation of more than 20 billion in holdings linked to Bill Huang's investment firm is drawing attention to the cover financial instrument he used to build large stakes in companies. Much of the leverage used by Huang's Archego's capital management was provided by banks, including Nomura Holdings and Credit Suisse, through swaps or so-called contract for difference, which is CFD. According to people with direct knowledge of the deal, just a second, please. Okay. According to people with direct knowledge of the deals, it means Archego may never actually have owned most of the underlying security, if any at all. Means Archego, most that Archego has been trading or using are those financial derivatives like swaps or contract for difference, which is the highly leveraged financial products. For example, I mean, for Apple's share stocks, besides owning Apple stocks, we can buy swaps or CFD or futures or option of Apple, which are the financial derivative with leverage. So the leverage can range for like 10 to even like 100 times of the spot share, meaning like we can choose to buy like 1,000 of Apple share, but if we use like futures, we can use 1,000 to actually own like 10,000 of Apple's asset, something like that. But if we use CFD, the leverage can go up to like 100 times. So that originally all of these financial derivatives are created for investors and hedge fund managers to kind of like manage their portfolio or doing some like a risk management or hedging for hedging purpose. But nowadays, when the market like become like, I mean, all the investors and banks and funds, institutional investors become more and more greedy, and all the instrument in the market become more and more complicated, bad thing will happen because the loopholes will just become more and more out there. So let's keep checking for the article. So while investors who build a stake of more than 5% in US listed company usually have to disclose their position and future transaction. That's not the case with stakes built through the type of derivatives apparently used by Archego. The products, which are made of exchange, allow managers like Huang to amass stakes in publicly traded companies without having to declare their holdings, meaning those major shareholders for any publicly listed company, they have to disclose their share and disclose their major transaction. So regulatory authorities like SEC or exchange can keep a close eye on what those institutional investors has been doing to kind of regulate them in a good pace. But for those derivatives, I mean, like futures and options are traded in exchange as well. But nowadays, a lot of the derivatives like swaps and the CFD contract for difference are not that much regulated. That is creating the problems. So let's keep going. So the swift unwinding of Archego has reverberated across the globe after banks such as Goldman Sachs and Morgan Stanley forced Huang's firm to sell billions of dollars in investment accumulated through highly leveraged bets. The sale of royal stocks from Baidu to Vicoms and prompted Nomura and Credit Suisse to disclose that they face potentially significant losses on their exposure. So I mean, this is gonna have a ripple effect for sure, like chain effect, because I mean Nomura's stock price has dropped like 20%, I think, and we need to keep a close eye on to see like how this would affect the the next. And one reason for the widening fallout is the borrowed funds that investors use to magnify their bets. A margin call occurs when the market goes against a large leverage position, forcing the hedge fund to deposit more cash or securities with its brokers to cover any losses. Archegos was probably required to deposit only a small percentage of the total value of the trades. That's a terrible part. The chain of events set off by this massive unwinding is yet another reminder of the role that hedge funds play in the global capital markets. A hedge fund short squeeze during a Reddit-fueled frenzy for GameStop shares earlier this year spurred 6 million loss for Gap Plug King's Melvin Capital and sparked a scrutiny from U.S. regulators and politicians. But it seems the event still going on for GameStop, and even we have like AMC, KOSS, EISCA coming out. So I'm not sure if the regulators still can keep this under control. We will see. So all right, back to the article. So the idea that one firm can quietly amass outsized positions through the use of derivative could set off another wave of criticism directed against loosely regulated firms that have the power to destabilize the markets. While the margin calls on Friday triggered losses of as much as 40% in some shares, there was no sign of contagion in markets broadly on Monday. But okay, contrast that with 2008 when Ireland's then richest man used derivatives to build a position so large in Anglo-Irish Bank. It eventually contributed to the country's international bailout. In 2015, New York-based FXCM needed rescuing because of losses at its UK affiliate, resulting from the unexpected depacking of the Swiss franc. Much about Huang's trades remain unclear, but market participants estimate his assets has grown to anywhere from 5 billion to 10 billion in recent years, and total position may have topped 50 billion. We'll be really curious what kind of effect will come up after this. Fund didn't respond to requests for comment. So CFDs and swaps are among bespoke derivatives that investors trade privately between themselves. As just mentioned, CFD and swaps are not like traded or regulated by the authority or by exchange. So that it's not really under the table, but the effect for those like CFD and swap trading are kind of like uncontrollable and unforeseeable, and a lot of times the problem for the market just come from there. And okay, so these products are traded between themselves or over OTC market instead of through public exchange. Such opacity helped to worsen the 2008 financial crisis, and regulators have introduced a vast new body of rules governing the assets since then. Over-the-counter equity derivatives occupy one of the smallest corners of this opaque market. Swap and the forwards linked to stocks had a gross market value of just 280 billion at the end of June 2020, according to the data from the Bank for International Settlement. That compared with 10 trillion for a swap linked to interest rate and 2.5 trillion for swaps and forwards linked to currency. Regulators have begun clamping down on CFDs in recent years because they are concerned that derivatives are too complex and too risky for retail investors. With the European Security and Market Authority in 2018 restricting the distribution to individuals and capping leverage, in the US, CFDs are largely banned for amateur traders. So I mean, in the past decades, we can see not only one in the past 1 or 2 or 3 decades, we can see like too much freedom for the market will always I mean induce a lot of crazy things, and I mean in the end those suffer the most are retail investors. So sometimes we don't know like if it's good to have much freedom or less freedom, more freedom or less freedom. Okay, so let's look to the end. Banks still favor them because they can make a large profit without needing to set aside as much capital versus trading actual security. Let's hold on a second. Another consequences of regulation imposed in the aftermath of the global financial crisis. Among hedge funds, equity swaps and the CFD grew in popularity because they are exempt from stamp duty in high tax jurisdiction such as the UK. So I mean, in the financial deregulation for more financial freedom at the beginning, banks, institutions, retail investors, and institutional investors have been all making some like good money or enjoying a lot. But I mean, before problem occurs, like everyone happy. But when problem occur, like all of us just realize this could be just like addictive drug, right? Like so. I mean, and this news just happened last Friday and it's still going on today. And we really need to keep an eye on it throughout this week or even, I don't know, or even throughout this whole year. Because like Archego blew up, just one of the story. We don't know if any other hedge funds are going to blow up like Archego. And we don't know like if Nomura or Credit Suisse can safely overcome this. But yeah, we'll keep an eye to close